All right, welcome. We're Ohio University, and we're going to tell you why Cintas is actually dressed for success. I'm Peter Rousseau.
I'm Patrick Wolf.
I'm Jason Mikishi.
And I'm Sean.
So first we're going to start off with the business description. I don't want to spend too much time on this because we have a 10-minute presentation, so we just go to the next slide. So you guys have heard what Cintas does probably 3 times now, but basically their main business, where they derive most of their revenue, is in their rental uniform and ancillary product segment. Another interesting component it was the document management service. In May of 2014, they decided to do a joint venture with Shred-it. This basically spun off their document management service into Shred-it, and they received $180 million and 42% of their future revenue. So I don't want to spend too much time on here because you guys do know what Cintas is, and we want to get into our kind of investment thesis. So here's our kind of macroeconomic overlook, and we're going to explain why that macroeconomic overview is good for Cintas. So the U.S. is a strong U.S. economy. Although GDP was stagnant in the 4th quarter, the rest of the foreign markets are very volatile. And the U.S. job report that came out was really strong, especially in the lower income sections. About 70% of the jobs that were created in January were actually in the manufacturing, the healthcare, and all these places where people do need their uniforms, and that's where Cintas will derive their top line revenue. Another part of our kind of macro outlook is the volatile equity markets. As you can see, the LNG, we kind of use the natural gas as a proxy for volatility in the markets. So if you can see in the past 16 months, the price of natural gas has gone up and down a lot. This is kind of indicative of all the current crises and global crises that are going on in the world. But what we really want to focus on is that the U.S. is strong, where the Cintas derives their revenue. So with these volatile markets, this really puts Cintas in a unique place. And that's what kind of Pat's going to touch on here in a bit. Another thing to look at is the increasing interest rates. As you guys know, the Fed is likely to increase those interest rates, as everyone thinks they are. But we thought that for the past 3 years, but we think that this is actually the time that they will do that. So I'm going to pass off to Pat. He's going to talk to you about Cintas' competitive position.
Great, thanks a lot, Peter.
Yeah.
So looking at Cintas' competitive positioning, they have operating margins of around 13.2% compared to the mean of their competitors, which is closer to about 12.1%. On top of that, their EBITDA margin is around 19.1% as opposed to the mean of their competitors, which is around 14.2%. So just from there, you can see that they really do have more efficient operations than their competitors. And kind of digging into that, and what we can see really at the most high-level view is that their size. So when you look at their market cap is about 9,500 as opposed to their closest competitor. Sorry, 9,500, that's pretty low. Versus 7.2. And so really what you're seeing there is just the fact that they're much larger than their closer competitor. And with that size, they really get much more efficient economies of scale. Also, really the competitors that we listed out and we really try to look through and find in their comps, really the only other one that did products and services was about 1/8 of their size. So in an industry where you're really looking at the benefits of economy of scale, they definitely have a significant advantage there. Moving kind of on to their segments of business, about 30% of the uniform rental and distribution market share is taken up by Cintas. Now this segment makes up about 70% of their revenue, which is obviously the largest portion of their revenue. And so through this, they're continuing to see more growth. They grew that segment by about 5.9% last year, top line, and their cost of goods sold only grew by 4.2%. So even now, even though they're a well-established business, they're continuing to grow it and grow it and grow it. We believe that's going to continue forward moving on. And when you look at kind of the operating margins of the weakest form in their business, which would be the uniform sales, that's about 10% of their business. And they have SG&A margins of around 18.2% compared to the company average of around 26%. And something Sean's actually going to talk on a little bit later is the risk we see associated with the uniform sales. So we think that even if there's an opportunity to then go ahead and spin off that business, maybe kind of wind it down a little bit, that would be a tremendous opportunity for Cintas moving forward. And with that, I'll pass it off to Jason to talk a little about the investment summary.
Awesome. So what I want to do here is, and what we want to do in general, is kind of spin across our macroeconomic theses to Cintas's competitive advantage and tell you why we're a buy on the company. So as we've already gone over, Cintas is a large, stable company with a focus on organic growth that has been kind of doing an expansion of margins over the last 3 years that has put it at the leading head of the uniform distribution cycle. Why we think it's a superior investment to other places in the market is because of the aforementioned volatile equity markets. LNG kind of seems like an odd way to serve as a proxy, but the commodity crisis of the past 12 to 18 months has been a very real catalyst for the intense movements that we've seen up and down in the equity markets in the past year and a half. Also important to note is that trading volatility has been particularly severe in the past month, with the major brokerage firms seeming to just take a whack at whichever sector that they just feel has run up too much in the last year. So with these three kind of thesis points in place, one with a focus on their stable cash flow growth and their stable profitability that was also touched upon by Patrick, and also the fact that they have a superior strategy for capital deployment with a focus on returning value to shareholders over necessarily buying into the already robust $3.7 trillion M&A market right at the moment, we can kind of see how Cintas is positioning themselves better than their competitors, and indeed that flows into why we think that they're a strong investment, because they can rely on the macroeconomic growth that Peter touched on while being somewhat insulated from all the trading volatility, since they have not been buying into many of the same trend lines that has contributed to the bull market of 2013 and to a lesser extent 2014 as well. Let's dig into, taking all those catalysts, let's dig into the valuation a little bit. We ran a dividend discount model with the important inputs being highlighted in the long-term growth rate of 7%, which gave us a terminal value of 88.777. Our cost of equity was basically derived from Bloomberg consensus. There is a small error in there in that the market risk premium is obviously take the sum of the risk-free rate and the equity risk premium, not the market risk premium. But all these were taken from Bloomberg terminal consensus calculations, and we didn't necessarily disagree with any of the assertions put out. We realized that the market risk premium of 5.4% could be perceived as low, but it's kind of in line with the tapering that we've seen over the past 2 years of how much we can expect to return on your equity investments, hence the semi-low cost of equity of 8.1%. But that generates a 19% upside right there. So I've already touched on a lot of these assumptions. The 7% growth rate is around 35% lower than the Bloomberg consensus for the long-term growth rate. They too ran a two-stage model on it. A couple of key assumptions is that we decreased diluted share count by about 5% year over year, which is in line with some of their share repurchasing programs that they've already put out there, and as well as growing their dividend per share by a fairly conservative, barely into the double digits, 12%, I believe, amount over the next few years. And that's sort of where we derive most of our forecasts from that. The discounted cash flow analyses, the major inputs to see here are the 7.35% WACC, which was calculated with much of the same assumptions as we calculated the cost of equity weighted against cost of debt, which drove it down as is somewhat expected. We only derived a 7.2% upside, though we did use the bull case in the scenario, since we think that those sales growth assumptions are more in line with our aforementioned sort of qualitative theses. The really important number to remember there is that there's a 3.8% terminal growth rate, which seems to be perilously high, but when you back it out into an EV/EBITDA exit multiple, you only get 12.9 multiple, which is actually more or less a similar premium as you would get if 5 years down the line if you run a DCF on them and all their competitors. We believe that they trade at a premium for a reason, given their market leadership. And the market finds themselves comfortable trading them at that similar premium. Other than that, let's move on to the comps analysis. We use 3 competitors: G&K, UniFirst, and Aramark. They do trade at a noticeable premium to all of these, but this is especially due to the fact that their margin expansion has been so good. Looking at the evaluation summary, we decided not to use the comps analysis for the reasons mentioned. They feel comfortable trading them at this premium. Instead, we used a 50% DCF and DDM to get an 11.51% upside. But no great investment is without risk, and that's why I'll turn it over to Sean to talk about some of them.
Yeah, I'm going to walk through the 2 areas of Cintas. And the first one is risk from potential M&A within the industry. And for this industry, the biggest competitive advantage is the ability to effectively grow and maintain margins. And for Cintas, should be wary of M&A activities from their peers. And because even medium-sized acquisition make Cintas lost their market share. So the reason for this is like.
Great. Now I'd like to open up to questions.
Yeah, on your valuation DVM model, slide 8, your top line, this question's on this a couple of times, top line revenue growth rate. I know you're bullish on the name, but how sustainable is that 6% growth? 16, 17, 18, 19, you have pretty formidable growth going into the kind of market saturation and other things. Have you thought about that? And that's the first question. And on the dividends per share, basically the bottom line there, dividend per share growth seems to be higher than recent trend. So I'm just wondering, is that signaling that the management team is, in your opinion, going to increase the growth rate on that, or are you just kind of extrapolating out the model here?
Right.
I read both of those models. So the top line revenue growth rate is expanded at 6.6%, which we realize is very bullish. It's more or less to make it in line with our DCF assumptions, which we believe are justified by the fact that we believe the trend line is them edging out their competitors, not vice versa. So we believe the competitive climate is more favorable to Cintas in the long term. As for the bottom line dividend growth, through talks with management when we actually visited the plant, they seem to be most focused on returning value for shareholders through share repurchases and growing their dividend, and that's why we baked in those assumptions. But it is important to note that in either one of those assumptions play maybe a 6% role into the overall valuation of what comes out of our DDM, so given the emphasis on terminal value.
You mentioned being a large and stable company, yet in the 2009-2000 downturn, profitability got dinged pretty well.
Right.
Can you maybe reconcile that comment with sort of what happened in that last downturn and why you think the company is now a stable company?
Right. So they did get dinged in the economic downturn like everyone else. They did improve efficiency kind of coming forward, and they remain that really large company with that really nice infrastructure. And as the economy grows, that profitability and that increase in profitability that they had really will allow them to grow even more as the U.S. economy grows, like the catalyst we said earlier. Do you guys want to touch on it?
Yeah, I mean, and then kind of just going off of that, I mean, obviously I've noticed a major macroeconomic downturn for the equity markets as well as for the U.S. economy. We believe that Cintas' success is far more correlated with the U.S. economy than it would be with the S&P 500 or any other kind of index, just based upon the point that, I mean, like, with such a low beta and like so little, volatility that this company would face, obviously solid economic growth, more jobs, they're going to sell more uniforms, you open a plant, you need all the safety equipment, you need all the fire equipment. So we believe that a continually growing U.S. economy is really what's going to be driving it, much more so than the equity markets.
When did you calculate the dividend to be?
It was 0.91.
0.91 for this, the unlevered beta is 0.91, the levered was 1.05.
So you talked about just market volatility, but you didn't point out necessarily any of their input costs and the volatility they might have seen there, and maybe commodities that go into their actual business. Maybe touch on that point.
Right. One of their main costs, I actually asked this to management when they spoke to us, is their fuel cost. They kind of downplayed that because they said there was price at the pump. But with gas prices like staying pretty low, and we think that they're going to stay pretty low for the foreseeable future, that is actually going to be a benefit to their kind of transportation services as well, or not the transportation services, but their transportation of their services. And we think that's going to really help their profitability as well. And if prices do go up, back to what they were doing before, that's still a positive, just because you've had time with low gas prices to kind of generate more revenue, or to generate more net income at the bottom line.
It comes out to be a pretty significant portion of their overall costs, where if we see gas prices stay about the level where they are right now, that could be accretive anywhere from 4 to 5 cents EPS to the EPS.
Can you kind of walk through the risk-free rate 2.15 and the Dorn market risk premium 5.4? Just kind of what was your thought process in using those numbers?
So 2.15% is slightly just U.S. Treasury 10-year, a little bit higher than what it's actually trading at right now. We figured that was a pretty good thing to benchmark against. Bloomberg thought it, and we actually said that helped to Bloomberg as we were generating this, and they said that they always like to keep it a little bit bearish so that they don't ever get ridiculous valuations on the back of just what happens in trading volatility. As for the Damodaran market risk premium, Damodaran has a somewhat bearish take on how well the markets will return in comparison to 2013, which was I think around 29.6%, and 2014, which was 11.4. He thinks we're definitely on the trend downwards, not upwards. So the 5.4% market risk premium is decidedly lower than any that he released in those years. As a result of that fact, I think reading the papers that he puts out, it kind of has a lot to do with the commodity crises that we see ourselves in right now. I do realize that earlier today, the major official at the EIA did come out and say that oil prices will inevitably rise due to the threat from ISIS, but it was one official compared to the supply forecast from the rest of the EIA saying that it would the prices would have to remain where they are. But it's obviously speculative.
Carol would say, what was your logic in using natural gas as a correlating factor?
It was sort of, natural gas was supposed to be a proxy for a lot of the world events that happened or playing out right now, and also what we wanted to show really is that foreign events can actually affect the domestic commodity prices. So the prices spiked in late October when Russia invaded or annexed Crimea and sent rebels into the Ukraine. I realized invaded is touchy language that I would prefer not to touch on. When Russia sent separatist rebels to the Ukraine, that's when it spiked. Ceasefire was declared, it went down, fighting's begun again. Where will it go now? It's supposed to be a proxy in order to be demonstrative of the fact that foreign events do affect domestic markets, and they can and they have.
So, what's management's history as far as acquisitions, hitting their return targets, and do they have, you just say, relative to the average where they stand as integrators?
I would say management's last acquisition was quite some time ago.
Last big acquisition.
Yeah, the last major one.
Yeah, last major one was quite some time ago. When we talked with management, they were decidedly bearish on current M&A markets, just because they thought that due to the low interest rate environment, they would get the premiums have been jacked up to a point where they don't feel comfortable buying. And due to the relatively strong cash position, I believe somewhere around 867 million, they think that they can make a good and creative acquisition without taking on debt once interest rates go back up and premiums conversely go back down. And then that's how they feel about it. But until then, interest rates may never go back up. There's certainly a number of economists that say that. Until then, Cintas has positioned itself well to deliver value to shareholders through the aforementioned share buybacks.
Yeah, they're in kind of a weird position because they want, not they want interest rates to rise, but if interest rates rise, they actually have a better position on doing future M&A activity because they don't have to pay those significant premiums that all the other companies are levering up to do. So they're in a kind of a opposition that if interest rates rise, they might actually want to do more M&A activity, and that's what we're kind of foreseeing as well.
What did your sensitivity analysis look like in terms of your valuation?
So I ran a sensitivity table on more so on the DCF than the DDN, on the WACC versus the terminal growth rate, and pumped down the terminal growth rate below, like to around 3.3% and 0.5% increments, and you see a pretty precipitous drop as you might imagine. We think that the terminal growth rate is somewhat justified just because of the exit multiple it backs into. Some of the analysts I've talked to that research the company agree, but I mean, there's also the fact that a lot of people